Hey everyone, I'm Dave. Welcome back to another video. If you're a subscriber, thank you for continuing to watch the channel and support the content. If you're not and you do find this video interesting, informative, or useful, please consider subscribing by the end of the video. Thanks so much. So today I am talking about options, and this is kind of a very beginner level introduction to options trading, how to do it, what the concepts are, calls and puts, things of that nature. I'm also going to go into how to make options trades on Trader Workstation, which is the trading platform used by Interactive Brokers. And that's the trading platform I use myself. It's a very, very common platform, but the concepts are useful on any trading platform, on any app. Knowing how these things work can be useful. So I do talk about options sometimes on this channel. I do make options trades fairly regularly, and I just thought it might be helpful for any investors out there get an understanding of these concepts and why you might want to consider using options in your own portfolio. Some of the benefits and drawbacks, because no strategy is perfect. So with that said, before we get into Trader Workstation and actually putting in trades on options, let's head over to the whiteboard and look at how exactly options work and where you might want to consider using them. Okay, so here we are at the whiteboard, and what we're looking at right now is a real option from yesterday. I screenshotted it from within my trading platform, what the call price is going for Rocket Lab. So at the most basic level, what a call option is instead of buying the stock today, you're paying to have the right to buy the stock for a certain price at a certain date in the future. So if we look at this screenshot, we can see in January of 2024, so way out, that's 597 days, we can have the option to buy Rocket Lab at a strike of $5 a share. So in about 2 years, we can buy Rocket Lab for $5 a share instead of just buying it for whatever it is today and holding it. And there's a lot of reasons you might want to do stuff like this, but let's just go into some of the calculations. So we can see the bid for this contract is $2 and the ask is $2.60. So usually you'd get it somewhere in the middle of that. So we're going to assume, for the sake of our exercise here, that we are able to buy our contract for $2.30. So $2.30 for each share. Now, something that's very important to keep in mind with options, if you don't realize this, you can get yourself into a lot of trouble, is that each one option you buy represents 100 shares. It is a contract for 100 shares. So if I am buying one of these for $2.30, I'm not paying $2.30. I'm multiplying that by 100. So I'm actually paying $230. So if you think you're buying something for $2.30 and you're actually paying $230, you can get yourself into a lot of trouble very quickly spending money that you don't have or things of that nature. So very important to keep that in mind at all times. One option contract is 100 shares, multiply it times 100. Okay, so let's say I have $1,150 and I want to buy options contracts instead of buying the actual stock. So what does that mean? If each one of these $2.30 contracts is times 100, that's $230. That means I am able to buy 5 contracts. So 230 times 5 is 1150. So I'm buying 5 contracts at $2.30 a share, timesing that by 100. So you have $1,150 for these contracts, where in 2 years, I only have to pay $5 a share in order to buy Rocket Lab. Why am I going to do this? Well, I think obviously it's because I believe it'll go way above $5 a share. You could just buy the stock in that scenario, but options allow you to get more leverage and potentially multiply your returns while also taking on more risk. So let's go into some of these scenarios that could happen. So let's say at this day, January 19th, 2024, Rocket Lab is going for $4.99 a share. So that's $4.99 per share. Okay, so let's think about this now. Rocket Lab is trading on the open market for $4.99 per share, and I have the option in my account to buy it for $5 a share. How much is that worth? Well, absolutely nothing, because you can buy it on the open market for less than you'd have to pay using your option. So you would never use your option. That means your return in this case is zero. You've just lost all your money. That is contrasted if you just bought the stock with the same amount of money, $1,150, and the share price is still $4.99. So I'll put the stock up here. So we know this side is stock, the other side is options. If we just bought the stock, then our return would be $1,217. So we've made money if we bought stock, and we've lost all our money if we bought options because we're betting it would go up by more than it actually did. So in this scenario, the stock is the clear winner by a long shot. And that's one of the reasons why you might buy stock. It's a lot safer. If it goes down, you still own your shares. You can be right later on. If you own the option and you're not right by this date, that's it. You lose all your money. So now you might ask yourself, well, why do you want to actually do this? If you have the probability or possibility of losing all your money with the option, and you're not really going to do that with the stock unless the company goes bankrupt. Well, let's keep going with these calculations. So that was for $4.99 a share in 2 years. What if the stock is at, let's say, $7.30? So now the stock in 2 years, when this option expires, is going for $7.30 per share. Well, let's think about this. The strike is $5. On the open market, you can buy the stock for $7.30 a share, but now you are able to buy it because of this option for $5 a share. So what you're making is the difference, right? You're able to buy it for $5 a share. It's really worth $7.30 a share. That means for each of those stocks, you're making $2.30. Now, if we times that by 500 for our 5 contracts of $100 a share, is $11.50. So this is our break-even point. This is our break-even point for the option. Now we haven't lost any money, but we haven't really made any money either. So we need it to go up to $7.30 in order to break even. Now, how does the stock do if I just bought the stock instead of the option at this point? Well, it's pretty straightforward. You have 244 shares worth of stock. You multiply that out and you get 1781. So the stock is still the winner here, but we're starting to catch up in terms of if we had gone with the option, right? Now, let's say Rocket Lab in the future actually doubles. So it is now going for $10 a share. So on this day when the option expires, Rocket Lab is trading for $10 a share, but we, with this option, are allowed to buy 500 shares for $5 a share. So that's pretty easy. Our return is $5 times 500, 2,500. Now we've turned our investment into $2,500 versus the stock. If we had just bought that, again, still 244 shares, we have 2440, so 2,440. So at this point, we're making more on the option, just barely. And you might be thinking, well, we've taken on all this extra risk because if it doesn't move, our investment is now worth zero instead of just keeping our money. But our returns are still not much better. So why would you do this? Well, from this point on, as we go up, the option will get you an exponentially higher return than just owning the stock. So for basically how this works is for every $2.30, which is what we paid, our return is going to double versus the stock where it doesn't. So let's just, for argument's sake, go with now Rocket Labs trading at $20 a share in 2 years, which would be a great return. Great performance for the company, but let's say you have the conviction, you've done all the research, and you think this is what's going to happen. So now it's $20 a share. So, and we're still able to buy the stock for $5 a share, and it's trading for $20 now. That means we're making $15 per share times 500 shares. So that is 15 times 500 equals 7,500. So now we're starting to get into some juicier returns for the option, right? We can see the returns are really starting to multiply. What does the stock get at this point? If you were just to own the stock, you would have $4,880. So now the option is the winner here. The option's the winner here. And as we go, if the stock is even higher than that, the option will outperform even more heavily versus the stock. One thing I would like to say about options is a lot of people say it's incredibly risky, and it can be. It can absolutely be extremely risky. But it's a tool, and how you use it dictates how risky it will be. You can be very conservative with your options and play it very safe. It's very possible you can play around with your dates. We picked an extremely far out date, whereas if we had picked a closer date to do these options, the returns would be higher, but obviously the risk is a lot higher because we don't have as much time. So if you're extremely confident that a stock will do extremely well, that's the scenario where you might want to buy a call option as opposed to just owning the stock, because as those returns go up and up and up, your option will get that outsized return versus the actual stock. Quick break in the video for a little promotion on Interactive Brokers. This is the trading platform I use for all my options and most of my investment trading. I wouldn't recommend it to you if I didn't think it was good. They have the lowest margin rates around in terms of borrowing money to invest, as well as extremely low costs for making trades, transaction costs, and just an extremely powerful platform that lets you do a lot of advanced things in Trader Workstation. If you use the link below, sign up, you'll receive $1 in free Interactive Brokers stock for every $100 of cash or other assets you deposit into your new account. I do recommend it as a great platform. So let's go to the other side of the equation now. And what we're looking at here is puts. So this is, once again, a real screenshot from the trading platform, Trader Workstation. At the exact same day, the stock price was $4.70 a share. Okay, so in this scenario, what I'm doing is I am buying the right to sell you Rocket Lab stock for $5 a share at the same date, January 19th, 2024. So far in the future, I am buying the right to sell you this company for $5 a share. Why do I do that? Well, because I think it'll be worth less than $5 a share. So I can sell you something for more than it will be worth at that point, and I will make money on that difference, right? So $1.80 is the midpoint, so we'll take that. So let's assume I am able to buy this for $1.80 per share. Once again, that's 100 shares per contract, and just because it's a little cheaper, we're able to get 6 contracts. So if we do times 600, that is $1,080. Okay, so we're spending $1,080 to buy 6 contracts where I can sell you Rocket Lab for $5 a share at that date. I know it gets a little confusing, but once you get the hang of it, it's pretty simple, really. So let's think about this now. What happens if at the date when this contract expires, Rocket Lab is trading for $5 or more? I know my writing is horrendous, guys. I apologize. So Rocket Lab trading on the open markets is worth $5 a share, and I own this contract where I can force someone to buy it from me for $5 a share. Well, that's worthless, right? Because I'm getting it from the open market for $5 and selling it back to them at $5. I'm not making anything. So this, if it's worth $5 or more, then we've lost all our money. That's zero. All our money's gone. If Rocket Lab is at least $5 a share, let's say it's $6 a share, right? If I have to buy it for $6 a share and resell it for $5, I'm not going to do that. That's just a waste of money. So this contract is worthless. I spent $1,080. I get nothing. If it's any more than $5 or $5. So let's say Rocket Lab has a poor 2 years and it's now at $3.20 per share. That's the share price it's at when this expires. Well, that means $5 minus $3.20 is $1.80, right? So the difference between what it's trading for on the open market and what I have the right to sell it for is $1.80. And then of course we multiply that again by our 600 because we have 6 contracts. And we get our break-even point. So if I'm making this trade where I can sell you Rocket Lab for $5 a share in 2 years, I already paid $1.80 to own this contract, so I need it to go down to at least $3.20 before I break even. If it goes down any more than $3.20, that's when we make money. If it goes down less than $3.20, we lose money, but the contract is still worth something. It's not completely worthless, but we don't make anything until Rocket Lab is below $3.20 a share. So let's keep going with the math. What if in 2 years Rocket Lab is doing absolutely horribly and you knew it, or you were very confident it was going to do horrible? So the share price of Rocket Lab is now only $1.40 a share. Well, that means I buy it on the open market for $1.40 a share at the expiry date. I am making $3.60 on every share, and obviously we know we have 600 shares, so that comes out to $2,160 I've made by buying puts, betting this company will go down. Let's go to worst case scenario here. Well, best case scenario for us, worst case for the person on the other side of the trade. Rocket Lab goes bankrupt, right? Shares are worth $0, but I can still sell it to you for $5. So I am going to end up making so it'll be $5 per share times our 600 shares equals 3,000. So at the end of the day, these contracts we bought for 1,000 is now worth 3,000. We've tripled our money, which is pretty good. That's our best case scenario here. So that's kind of some basic math on how these options work. I'll ask you to forgive my chicken scratch handwriting, but basically you're buying a put. That means you force someone to sell the stock for that price at that date. You're buying a call. That means you're allowed to buy the stock for that price at that date in the future. And you can adjust the date. You can adjust the price, play around with it. There's also more options that I haven't gone into yet where you can take the other side of these trades. You can sell puts and you can sell calls. I'll probably go into that in a later video because this is already running a little long, but that's some of the basic math on how this works. So if you want to bet a company will go down, you buy puts. If you want to bet a company will go up big, you buy calls. And you can, in the case of the call, multiply your returns more than if you were to just own the stock. Downside being, if it doesn't go up enough, instead of still owning the stock at whatever it's worth, you lose everything. So definitely can be higher risk and higher reward, but all depends on how you do it. Selling calls, extremely safe way to make money. Maybe I'll probably go into that later on. Unfortunately, the whiteboard section of our video went on a bit long, so I think I'm going to have to cut it off there and make a part 2 where we go into the Trader Workstation trading platform and actually look at submitting option trades, what it looks like, how you can access the different options and how that works. But I hope the first half of the video was informative for you and you learned a little about how options work and how you can make money off of them, different strategies you can use, just the basics for beginners. If you enjoyed, please consider hitting like and subscribe, and I'll see you next time with part 2 of this video. Thanks, bye.